We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Vince Lanci, professor of MBA Finance at UConn, commodity portfolio manager, and publisher of the Goldfix Substack. Vince, thanks for joining me today.
Thanks for having me back, Tom. Good to be here.
Always a pleasure, Vince. You know, you and I have some excellent discussions, and in the last, I believe it was the last time we spoke, you had identified this kind of Chinese gold whale, or gold buyer in some senses. So I understand there's a bit of an update with that. So why don't we start with talking about, give us a bit of an overview of who that, let's say, that whale is, and then we can kind of move into the new market developments around that.
Yeah. Okay. So the current event is that spurred this revisiting of it is Goldman Sachs updated their projections of physical gold buying by China, period. And that's one of the things that's making the market rally, and awareness of that is spreading. And when they talk about it, they're talking about who's buying the gold out of China. And for them, it's official buying by the PBOC, their central bank, as well as unofficial buying, which is coming in through the over-the-counter market, which they estimate using some data that they get from the LBMA. And for the longest, so they raise their projections. So that's what brought this all to light. So it starts with, without going too far back, it starts with when China started buying gold publicly, PBOC. Every month they were letting people know they were buying. They were also buying clandestinely or secretively. Mm-hmm. And they were buying through entities like commercial banks, through SAFE, which I forget the initials, what they stand for, but it's basically a government entity. And they were buying through the military. Now, you won't see that publicly, but that's one of the ways that they buy, because the military is off balance sheet. It's a separate entity. And that's that's what I was working from my own education on China's market structure. And then, when was it? It was July of last year. I stumbled on, and I've been tracking this, China buying and, what the banks are saying about it. And Goldman was the only bank really being frank about it. But then I stumbled on an article coming out of China about this, and I'm probably going to butcher his name, but it's Zhang Kai, or I forget how to say it, ZhongCai. This person who runs a fund. His first name is Bai, not the Bai that we talk about. He runs a fund, and the fund's named Zhang Kai Futures, something like that. And he actually was publishing what he did in like a note or a diary. He calls it a diary. I don't know where the translation gets lost there, but he calls it a diary, and he says what he did in the past. And when he said it, a light bulb went off for me based on an early education on Chinese market structure, which is going to bring us up to date. In China, it's a state-controlled marketplace, and it's a state-controlled economy. And so as a result of that, you don't do anything without the government telling you it's okay. So if the government's going to be buying gold, to get right to the point, they're going to tell you don't buy gold, and you will listen to them, because it's kind of like what we do here implicitly, they do there explicitly. We use monetary policy, they use a lot of capital controls. But anyway, to stay on point, over the years I had witnessed that night, trading gold that night, and it wouldn't affect gold that much, but it would affect things that I didn't trade. I would notice that iron would rally, like explode. Rebar, we're just talking about the O's. Iron and rebar and copper would rally, and I had a friend who ran the Goldman Sachs Commodity Index, and I would call him up or text him and say, they're buying all these in China. Aren't they going to buy silver? He goes, yeah, they're probably going to buy silver. Why? He's like, well, because the government's buying it. I'm like, what do you mean? He goes, if the government, why is it going up if the government's buying? He goes, because all the banks that work with the government are also buying it. They're front running each other. And I'm like, oh. He goes, oh yeah, they have a policy. They buy it for 2 weeks. Then they tell the banks to buy it. I was like, oh, it's like Gordon Gekko giving a taste to his friends. He's like, yeah, it's exactly like that. And I go, and then the cycle would end back then. This is important, although it's a nuance. The cycle would end back then. So the PBOC would buy, and then the banks that are affiliated with the PBOC would buy publicly. Not publicly, but they would buy a little bit more sloppily. And then the retail would buy, and it would spike and explode. And then they would change their capital controls, and everything would crash again. And there used to be these cycles involving Chinese policy. So when I read the Zhang Kai stuff, I went, oh, this is one of those guys that front runs the government when they let him. And sure enough, he's like a retired general. He's in the CCP. Like everybody, it's very mafioso in the sense that you touch base with the boss, you're trusted by the boss, or you don't get to do stuff. You know, he runs a plastics business or something, and he starts a hedge fund. That's because he's got the info. Anyway, so he goes head to head with JP Morgan out there, and he buys calls and he buys metal and he takes delivery, and basically they have a horrible quarter or half a year as a result of that. That's the rumor. You won't be able to see it, but so.
He had a horrible quarter or half year?
Well, I mean, not publicly. Let's just put it this way. Maybe China's exaggerating his effect, okay? But they said, and we reported it, taking the Chinese story and, adding to it, that the counterparty, he made $10 billion. The counterparty to his trades was JP Morgan. Therefore, they lost $10 million. That's not what happened. JP Morgan laid off their risk with the other banks who lost, $8 million. Anyway, the point is he made $10 million. Somebody lost it. JP Morgan was on the opposite side of that trade. So it's reasonable to assume that they got hurt by it, especially on the option side. But so back then, I saw that in July of this year, and I went, because I had been, and the time frame starts in 23 when he's doing this. And I had been studying that because I knew that somebody big was buying, and I thought it was a sovereign wealth fund. Maybe it was a Chinese sovereign wealth fund. But anyway, when I had seen that, I went, okay, here's the pattern that I was raised on. And that pattern is the PBOC buys for the government. Your buddy buys at the bank or at some hedge fund that the government has blessed. And then the retail buys. And then they change capital controls and get smacked down. Well, what happened in this last cycle was the PBOC bought publicly. They stopped buying. This is all there. They stopped buying publicly, and then they continued buying quietly. And this guy also bought calls and just ran everyone in. Unethical, possibly, but certainly not beyond the pale compared to what Western banks do. So, and there was no government squashing the retail. The retail made money, and I'm like, oh, I wonder if that's happening again, and Goldman starts talking about China is not supposed to be buying, but they are. And I went, oh, is this Zhang Kai guy buying again? And I don't have him on the record as buying yet, but the behavior is very similar. And that behavior is China picks a price. Any central bank will pick a price. This is the price we want to buy it at, but we want to buy it with liquidity, meaning I want someone to be selling it so we can just buy it and not move the market. We want to absorb, we want to catch the falling knife. And if you're a technician, you look at the chart, it's manifest in the chart. The 100-day moving average held for gold the first time, and then it held a second time, and then it was tested a third time, and now we've just kind of pulled away from it in orderly fashion. And I believe that when Goldman says China is buying through this OTC mechanism, the London physical market, it's this guy and people like him. So China is buying, China owns gold through its people, and they've done two or three things recently directly that are affecting the market. Number one, they now have permitted people with bullion accounts to withdraw the physical metal. They didn't permit that before. Before it was big enough. they allowed their citizens to have bullion accounts connected to their savings and checking accounts. Imagine if we had that, what the price of gold would be. It's like, I'm going to transfer money from checking to savings. No, you know what? I'll just buy some gold with it.
It would probably be almost the same because the West doesn't have that awareness of gold the way the East does.
That's right, and they're not going to let us have those type of accounts. Oh, you want to buy gold? Here's an ETF. You can't take physical gold. So they created this mechanism. Liberalization of gold ownership is basically the category, and their citizens started buying gold, but they couldn't get delivery if they just were getting a receipt. You have the gold, we have it. Trust us, we're the government. And now they're like saying, and recently they said, well, now you can actually take delivery. And so the gold is leaving the vault. And that's creating even more awareness and more bullishness. It's like gold is becoming like an IPO'd stock for China. So you had that happen. You had China restart their gold buying publicly. They're buying more than people expected them to buy privately. And lo and behold, there's no event, there's no election, there's no BRICS summit. There's no thing that's about to happen. And lo and behold, gold starts to take off and pull away from the 100-day moving average. I think this is like one of your soundbite headlines. Not that you do it, but I think we'll be at new all-time highs in a couple weeks. Where we go from there, I don't know. But I think it's very reasonable to think that something is going to happen again. And the final nail in the coffin is for the last 3 months, for the last 6 months, mostly the last 3 months headed into the election, the bullion banks were no longer selling. So when someone bought, someone else was selling. Like it was a hedge fund selling. It was the BIS selling, I would assume. It was a producer selling. But the bullion banks themselves were no longer taking fresh short positions. They were handcuffed because they were losing money or they were being careful. Well, the last 2 or 3 commitment of traders reports, the bullion banks have put on, they're selling again. So they're getting short again, and I think they're about to get run over. So that's my long story. Goldman ties in with these whales that are buying. Zhang Kai is one of them. And that's the physical demand, and it's directly and or indirectly tied to China's government buying. That's it. They're buying again. It's going up. That's it. Yeah.
So how does this tie into this growing spread of the EFP premiums, Vince? I spoke to Bob Coleman about this the other day. You might have a different perspective on this. So when you say these bullion banks might be getting run over, is this because they're trying to cover their shorts? And zooming out a little bit, the tariff anxiety is also kind of creating this new or different flow of physical metal around the world at this point. I know that's a big question, but we can
you gave
break
me a
it
lot
apart.
of you gave me multiple rabbit holes, so I have to break this apart. All right. Starting with the EFP itself. The EFP is and I'm probably going to say some things that Bob said, but Bob's comments and observations on it have been spot on for the last probably 3 months, and he and I both understand the EFP very well. Completely different backgrounds. He's a physical guy who understands what the EFP represents in his industry, and I'm a financial guy who used to look at the EFP as a kind of canary in the coal mine to tell me who's getting hurt. So to start with one sentence, the EFP is not an indication that the bullion banks are getting hurt. It's not. Okay, it's an indication that the bullion banks are making sure they don't get hurt. That's the first thing I want to say. The second thing is, are the bullion banks going to get run over? Well, I use that term loosely. What I mean is, over the next 6 months, they won't make as much money as they normally would if things continue. So they're certainly not going to be. They know how to say no. They know how to stop playing. But getting into the tariff and the EFP. That's one driver of the markets, both gold and silver. And the physical demand coming out of Asia, let's assume that's China physical demand coming out of Asia, coming into Europe, that's entirely different. Now, the China demand can affect and does affect the EFP, but not like this. Mm-hmm. What's happening now is the EFP, or exchange for physical, is, it's not a thing. The EFP is the hole in the donut. It really is. Like, I'm sorry, I have to use a donut, right? There's the left side of the donut, and that's in London, and there's the right side of the donut, and that's in the US at New York, and in the middle is the EFP. The EFP is the space that governs the relationship between London versus New York gold. And the reason the difference matters so much is because New York is where the price comes from. New York is the futures market. It's the financial center for gold. The physical center for gold is London. So when you buy gold on the COMEX, yes, there's a COMEX vault. Yes, there's COMEX metal. Yes, you can take delivery. If they let you, you can take delivery. But ultimately, the metal comes from London. And it may get parked in COMEX. It may get stored in COMEX. But London is where the physical side of the business is. So why is that? Well, it's centrally located. It can handle the Americas or Europeans business. It's part of, to paraphrase Tom Luongo, it's part of the severance pay we gave Great Britain after World War II to allow them to stay in business. He's not wrong. And the refiners, the smelters, the vaults are all in Europe.
Mhm.
You go to Switzerland if you need your gold bar made. So the metal would come up from Africa, or from wherever, go into London, get refined, get stored in London. If they need it in COMEX, they ship it there. Okay, so this stable relationship is, London gold is New York gold. That's the assumption. That's the donut, right? Okay, well, now for the EFP will move for various short-term reasons. Okay, they want a little gold in London. We're going to have to ship it back from the US, and the EFP will kind of tweak a little bit to show you that there's a little bit of an imbalance. In that sense, it's a scale or a seesaw. Enough analogies, but what happened with the tariff fears is that it's not just where the metal is, it's who makes it. So, for example, let's say that it can happen multiple ways, but in simple form, let's say that the COMEX has metal in it that someone owns and is storing there and is shorting futures against it.
Mhm.
But those bars are manufactured and have a brand on them from Mexico, or they came from Mexico or Canada, or let's pretend it's Nazi gold. You can't have it there,
Mhm.
right? Okay, can you have Canadian and Mexican gold there? I mean, silver there? Yeah, you can, but your short contract, see, the COMEX has its tariffs put on the price, and that was our way of saying we have no tariffs. It's not after the price.
Right.
We're a free market. We have no tariffs, right? But now it's like if Trump says, now we have tariffs, well, the COMEX price should go to a premium. Let's say the tariff is $5. The tariff price should make COMEX gold be $5 more than London gold. And that's not definitely going to happen, but you have to start worrying about it. So now I'm short a contract on COMEX as a hedge for my long Mexican Nazi gold. You get my point, right? And
Yeah.
I have a choice. I can deliver my Mexican gold against my short contract, but when they see the brand is Mexico, they're going to add $5 to it. And I got to pay the $5 because the price is the price, right? All right, so now I have a choice as a trader. I could say, all right, I can get rid of this gold and find other gold, which, by the way, we did. We were getting rid of Russian gold in the U.S. on the COMEX, finding other gold to swap it out for. But Trump kind of surprised everyone. So we can't get rid of the Mexican gold on the exchange fast enough. Maybe we can over time. So now I have a choice. I can go in and I can just buy my short back and just say, you know what? I'll go unshorted, unhedged for now until I find the other silver or gold that I need to replace my Mexican silver or gold. Or I could do nothing, And so it's kind of like a prisoner's dilemma. So if you're mathematically inclined for this sort of stuff, which I have to be, because if you don't know, you have to look at the marketplace and say, what is the chance that Donald Trump, by the way, I'm giving you the type of math that Goldman did in their most recent report on it. Mm-hmm. What is the chance that let me see if I can remember what they said. What are the chances that Donald Trump will enact a 25% tariff on silver? Well, a 25% tariff on silver is 25% of the price. So the price would go up by 25%. The EFP would change by that dollar amount overnight if it happened. But it hasn't. It's changed by $1. And that dollar is a reflection of the probability of it changing. Well, it's like the odds in Vegas or from a bookie are being moved. So, for example, on the COMEX, even at the highs in silver, it was still only discounting a 15% chance of Trump enacting these 25% tariffs. In copper, however, it was enacting a 50% chance, close to it. So the EFP, the market was trying to figure out what to do. And so, not to mention, well, Trump's not going to do 25%. He's going to do 10%. There's going to be a carve out for silver. There's going to be, all these things, and it kind of screws everything up. The EFP just says, you know what? Screw it. Simultaneously, now I'm a London trader, and I see all this crap going on in the US, and people start calling me up and saying, hey, Vince, can I have some of that London gold? Because I need to replace my Mexican gold. The London gold is made in Switzerland. We love Switzerland. There's no problem there. And I just go, well, yeah, the first time I go, yeah, sure. Give me 50 cents. That's the EFP, let's say. And then 50 other people come and say, what the hell's going on here? Oh, Trump. No, you can't have that. No. Why would I sell it to you at the price that I have it here for when I can sell it on COMEX $5 higher or 50 cents higher? And so the market starts to adjust. And so savvy traders, greedy sociopaths, which is what I was, say, oh, you know what? You want it? You can't have it. I'll wait for the price to go up. And so the EFP gets stretched and stretched until it'll go back and forth. And so if it's a crisis, the EFP goes, the metal is fixed, and the EFP goes back down. Mm-hmm. The EFP went, the tariff chances are lessened, the EFP came down, but it's not going away. I think we're going to be looking at an elevated EFP and a constant concern about tariff risk for the next year or so. And so that's going to make everyone kind of pull out, which, by the way, just to throw the word in there because I like to say it all the time, that's mercantilism. Literally mercantilism. You can't have my bullion. Mercantilism is about precious metals. You can't have my silver. And so it's like the world splits. Everyone goes to their corner. Everyone takes their own metal back. Remember when your listeners may know this, your viewers may know this, HSBC shut down its American operation. And they took all their metal and they moved it back to England and they moved it to Asia because they knew unknown shit was going to happen. So the EFP is reflecting uncertainty about the future in tariffs, which, just to give you the bullish comment, if we enacted those EFP tariffs, a smart neo-Keynesian a clever neo-Keynesian would say to you, well, that's a tariff. That's not the world price. Bullshit, because when the U.S. exercises a 25% tariff, the other countries are going to exercise tariffs to make sure they don't sell their metal too cheap. Mm-hmm. And then we're the U.S. Even though we're losing market share to China, we still are the global price differentiator. So I'm an idiot long silver in, Botswana. And I go, oh, look at the price of silver. It's this price on COMEX. Well, then I'm not going to sell it for anything less than that price here. And all of a sudden you have a liquidity crisis. You can't get the metal because the tariff ends up becoming a global phenomena. So metals are just going to continue to drift or spike higher because of the EFP tariff risk. Mm-hmm. The other EFP thing, which ties to China now, is that, and I can't figure this out, so I have to go with China as it. The EFP tariff risk, just to really put a fine point on it, is mostly silver in the U.S. It may be gold, but I don't see how it could be gold. That's another conversation. But the EFP continues. I'm sorry, go ahead.
I was going to say simply because let's say the amount of silver that has to come from countries outside of the US versus the amount of gold that can come from the US as a producer, right?
But, that's a very, very important point. We are importers of silver more than we are of gold. Absolutely. The other point is, I think.
Sorry, Vince. I just want to cover this one other point that you mentioned at one point. It's not necessarily a tariff on silver itself. Like you said this during your explanation.
Right.
But it's a tariff based on the country of origin, as I understood it, right? So if it comes from Canada or Mexico, let's say, as those two examples, that's where that tariff comes from, and it's not actually the tariff on gold or silver.
Right. Okay. Yeah. So let me put that. Let me. Yeah. You brought up a point that I glossed over. We're not tariffing silver. We're tariffing finished products from a country, and so silver is a finished product from that country. And if we're buying, whether it be Toronto Maple Leafs jerseys made in Canada or silver bars, we're going to have to pay a tariff on them. And I think gold will not be subject to that sort of a tariff. This is my opinion, because gold is money. It's not used for anything else. It's not industrial. So you can make the case, and you would want to make the case as an American, that gold doesn't get tariffed because we don't use it for anything. However, silver is a finished product that's used in industry. And so if it's used in industry more than gold, much more than gold, then it's going to be subject to tariffs. So that's it. Yeah, we're tariffing countries, not metals. And it's very odd that we would that would affect metals, but silver and copper are on the table for that now. So that makes it so it's kind of like if I'm a trader, I'm in Switzerland, say, oh, I'll take that Mexican silver from you at $1 over the price, and I'll just scrape off your brand and put mine on and say it's Swiss silver, and that's how it works. Middlemen make money on that, and what are bullion banks? Middlemen. What is the EFP? It's a reflection of the middleman about to either get run over or make money. And usually it's because he's making money. The EFP is where they live and breathe. The other thing is the gold thing, but there's still a problem in gold, and I haven't figured it out yet. So either I'm wrong and the EFP is affecting gold because of the tariff risk. Let's assume that I'm not for this part of the conversation. Or China is just buying the shit out of gold in London because they're taking delivery. And I tend to believe it's that because supplies of gold in London are tight, even though we're not pulling it over here. So we've got plenty of gold over here. And maybe we are pulling it over here. But the point is, someone's taking delivery of gold as opposed to someone's worried about short contracts in silver. So maybe they're all the same. It's all the same thing. They want the metals. That's it.
Yeah, just different reasonings and different nuances to understand about what's driving each of those markets. But and that ties into this point of what it means when gold rallies like this and silver gets left behind.
Oh, well, that's a nice segue, but that's unfortunately financial. So how could the silver EFP, here's a fair question that I ask myself. How could the silver EFP be discounting a problem in getting the metal from one place to the other, yet the price on the COMEX is not going anywhere? Well, as a bullion player, I'm not, but pretending that I am, I'd say, well, that's because there's plenty of silver, and if you just give it a little time, we'll find it. That's why silver is being left behind. Okay, and that's probably true to an extent. The other aspect is it's financial. It's people didn't talk about this until I started talking about it, because I don't think there were a lot of people that wanted to talk about it because they made their money that way. But when I traded financially, gold and silver and copper and oil, I would frequently use silver as a hedge for gold because I was bullish on gold or I was bullish on silver, and I would sell the other metal because it reduced my margin requirements. So I have to have $10,000 up for gold, but the COMEX would allow me to, because they're related metals, would allow me to sleeve some of the risk. some of the margin money, and so I would do that. So that's the first thing. Financially, they link them so that you can do that. So everyone says silver is not precious, but you can cross margin it preciously. The more easier, more less financial. The less financial reason is simple. It's central banks want gold; they don't want silver, and so that's been the fundamental reason for the separation. Yes, they're repressing the price of silver. I just know that has to be the case. And that's another conversation, but it's opinion. But ideally, right? We're in a setup now that silver should be lower relative to gold. Not lower than it is now, but should be. You have number one, you have central banks buying, right? Number two, you have a Fed back to saying, well, I might not be easing anymore. So if silver is an economic metal and gold is a precious metal, in your mind, not my mind or your mind, but someone's mind, well, I'm going to buy gold and I'm going to sell silver. I'm going to look at silver like it's like copper, and I look at so silver kind of on these type of situations gets it's the orphaned metal. You know, copper's economic, silver is sort of precious. If investors want pure plays, I want to hedge for war. Do you buy silver? No, you buy gold. Right? And then you buy silver when gold gets too high, right? I want to hedge for economic risk because the Fed might not ease anymore. Well, do you sell gold? No, you sell copper and you sell silver because silver really is more of an industrial metal in its use now than precious. The problem is people like me continue to believe it's precious, and it is for reasons that you can't destroy it, and it's very hard to recover. So that's why silver remains underwater relative to gold, and it can get worse. But just to give you the flip side of that, 5 days ago, I put on a personal position, long silver and short gold. The opposite of what the world is doing right now. Opposite. Mm-hmm. And my rationale was, yes, there's gold buying. The tariff is going to cause someone to freak out, and I believe that silver will have one of those 6% days. So it's like a 1 month to 3 month trade. And for about a week, I was hanging in there. And then the last couple of days, as gold started to pull away from the 100-day moving average higher over the last, say, 2 weeks, and silver went back and forth vol, I went, oh, I'm wrong. Somebody's selling. The guys are back. The guys are back. I want to buy gold and I want to sell silver for whatever reason. Everyone wants to sell silver. And so I literally covered my gold short yesterday before the close. So today I think I lost money in silver because it was down, but I didn't lose money in gold because it was up. So I have the position on, and I expect a big trade in that, but it's just a trade. Over the long run, you want to own gold for slow and steady income, for slow and steady profits. Mm-hmm. And you want to own silver because over the longer run, when there's no more gold left to buy, they're going to buy silver. Central banks are going to start buying silver, not the Western central banks. Mm-hmm. Russia has already announced it. Mm-hmm. They're going to do it. And
as a
Bank of
strategic
America,
metal, though.
Exactly. They're going to call it, right? Exactly. They're not going to call it money. So that's exactly it. Bank of America just put out a report that we covered. And in it, there was this section talking about silver as a central bank asset. I'm like, you guys are idiots. But then I read it and I'm like, oh, apparently, I didn't know this at all. Apparently, BRIC central banks for years had silver as a monetary asset. And they had been getting talked into selling it for the last decade. And now they have none left. And Russia announces they're going to buy it. True, not for monetary reasons, as a strategic asset. Mm-hmm. But I also believe it'll be monetary if the BRICS get their shit together. Because silver, I mean, it's very bad to use silver as money in international trade, but they're going to do it again. And I say it's bad because you can get squeezed really easily in silver. So I think where was I? Except to say that silver will not be left behind in the really long run. So over the next 6 weeks, I thought silver should go up. I still could be right. Over the next 6 months, gold will continue to rally in an orderly fashion. And over the next 6 years, silver is going to have its day in the sun. So if you live long enough, right?
Yeah. Vince, you tweeted yesterday this kind of, I guess it would be like a good summary of where we are right now. And what I mean by that is talking a little bit about this tension between moving all manufacturing back to America and being able to produce the same goods that we constantly demand without somehow raising the cost of those goods to suit American wages and American labor standards, let's say, versus having this, as I called it, the release valve of the dollar. So can you explain that tension to us and what the probable outcome of that is?
Yeah, the release valve is a good phrase, and we talked about that before we started recording. Yeah, Donald Trump wants to make America great again. In order to make America great again in a mercantilistic world, you need to manufacture and export more than you import. That means no more debt. That means no one's going to give you credit. You've got to finance yourself, et cetera, et cetera, et cetera. But physically, you need to sell stuff. You need to export again. And we don't export anything except maybe for, newsletters like mine. But we need to export again, which means we need to manufacture. So if you're old enough to remember, in the 70s, we ran into a brick wall in terms of manufacturing. We couldn't compete manufacturing anymore. Labor was cheaper overseas. Companies were moving there. And so we changed the whole economy's structure from manufacturing, shut the car factory down. Detroit moves to Mexico and started services, banking, insurance. And so we became a service economy. But now we need to become a manufacturing economy again. China won't give us credit. That's a reason, number one. And if you can't get credit, then you need to actually sell stuff. You can't sell services on credit as much as you used to. All right. So Trump comes along and says, correctly, in order to make America great again, at the policy level, taking the ideology to the policy, he says, we need to make stuff again. And Trump's a real estate developer. He's going to build stuff. He's going to build factories. And these are great ideas. We're going to build a factory. We're going to have our labor force become manufacturers again. And we're going to export stuff. And we're going to win because we're innovative, because we have all these natural resources here, and because I'm going to make it happen. And you know what? I believe him. The problem with that is, the con of that is, he has to deficit spend more than even Joe Biden did. Mm-hmm. Now, we can debate on what the numbers are, but the marketplace and experts who really know their shit, not just people called experts, have said, look, in order to do what he wants to do, he needs to spend money to physically build the factories. It's that simple. All right. And where is he going to get the financing for that? Well, China's not buying anymore. We've got to buy our own debt. So it becomes a deficit problem. It becomes an inflationary problem. And so his solution was, all right, that's what he wants to do. That's what he needs to do. How's he going to do it? Well, he's going to reduce. So you need to tax and spend to do that. You need to tax and spend. But he's like, no, I'm a Republican. I'm not going to tax and spend. I'm going to tariff and spend. Mm-hmm. I'm going to reduce taxes because it gets him elected. At least he says it. And then I'm going to use tariffs. Okay. So the problem with that is, and let's say he's completely successful. It doesn't happen overnight. Overnight, if you hit a switch, the factory's not built yet. You've got to spend the money. You've got to line up the creditors. You've got to do, these are real things. And they don't happen like in a video game respawning. So what does he have to do? Well, he has to get this to happen. Well, part of that process, even being extremely optimistic about it, is this is Michael Hartnett talking now at this point. He's on a schedule. If he can't get it done in the first 100 or 200 days, mm-hmm. then the tide turns from him being a president with a mandate to a lame duck. Republicans that are going to be elected or up for re-election or nomination again, in 2 years, they start worrying about getting elected. The economy won't stomach straight up inflation, deficit spending. They won't stomach it. People will you'll start hearing the left say, inflation, you made inflation worse, make inflation great again. I could just I can just see it now, And so he'll lose his ability to execute, which is why he's out of the gate as aggressively as he is, in my opinion. And I think it's a really good sign. Hopefully it'll keep up. Okay, so now I'm channeling Scott Bessent, his Treasury Secretary, who basically said that note that I posted out there that I summarized, and he basically said, "Look, we need to manufacture again. Our manufacturing is not competitive. We don't have factories, and even if we had the factories, we pay our people too much compared to the 16-year-old kid in Indonesia. Our standard of living is too high to compete with poor Asian labor that's just coming out of." A shitstorm, or even Argentina labor, probably the way things are now. Okay, so we can't compete even if our factories are built at the cost level. China is the manufacturing giant that we have to compete with. How do we compete with them? Well, if you can't make a product that's literally cheaper to make with slave labor, right? And you can't make a product yet, because it's not built yet, that people want and need, like an iPhone, no matter how much it costs, then you have to stay competitive by making it cheaper in dollars. So Bessent said, and he's right, and other people said this as well, Bessent said, we need to rebuild manufacturing. Tariffs ain't, whether we get them in or not, tariffs ain't going to do it. And if they do it, it's still going to take time to make the manufacturing, right? Here's how we do it. We reduce the deficit by reducing our cost of energy. We can do that. And what does energy do? Energy is what you build shit with. Energy is what you make stuff with. So we will become the low-cost producer of energy again by drilling, by building refineries, and we will channel that low cost into making low-cost manufacturing.
Which ties in to one of the most recent executive orders as well.
Absolutely. That's why he's energy focused. Energy leads to manufacturing. Manufacturing leads to, believe it or not, a strong dollar down the road, right? No, but it's good. So Bessent was saying in the back half of his term, if we're doing it right, the dollar will strengthen on its own. But in the front half, we need to use a safety valve while we're getting our shit together. We need to buy some time, and that is by making a weaker dollar. And so I believe that every time you hear news about it, if you hear, you might be successful. The moment you start hearing news about, well, we're not going to tariff China, we're in negotiation. That's the dollar weakening. Oh, well, we had a conversation with Canada, and they're going to bring back the Montreal Expos, and we're not going to tariff them. That's going to be a weaker dollar, right? In Mexico, it's like, okay, we're going to annex Cabo San Lucas, and they can have California, and we'll do a flip, and there'll be no tariff. Like, that's a Trump deal, that type of thing, And so every time you hear a negotiated deal or a failure to tariff, that's the dollar getting weaker. And I think the dollar has to get weaker in the first 2 years to do that. The only other way the dollar cannot get weaker and they can do that is if we all take pay cuts. And we can do that if we all take pay cuts, but we're not. We're just going to get people fired, and unemployment's going to go up, and you're going to have to lower rates, yada, yada, yada. Powell has to give in or be replaced. There you go. Weaker dollar.
So when you say that makes the dollar weaker if we're renegotiating these tariffs,
right?
Is that an overt or a controlled way because of demand to make the dollar weaker? Or like, I want to understand the mechanisms of how we actually engineer the dollar lower to achieve those goals.
Right. Okay. All right. So let's there's no moving parts other than the tariffs here. Okay. So the Fed's not easing. There's no increase in deficit. There's nothing going on except will we or won't we tariff? If we tariff and Canada wants to do business, if we tariff Canada and Canada wants to do business with us, they will need more dollars. And so the dollar goes up because they will have to accumulate more dollars.
Right.
When you tariff, you force people who must trade with you, who must buy from you, whatever we're selling, right? You force them to look for more dollars. So every time there's a crisis, you want dollars. A tariff would be seen as a a shortage of dollars. Things priced in dollars will go up. Of course, there's going to be counter initiatives, tariff. Canada will tariff us, what have you, but that'll just make them catch up. So eventually everything evens out at a higher level or lower level. So the moment that a tariff is not going to happen, all those dollars that I was hoarding as a Canadian, I don't need them anymore. So I'll convert them back to the Canadian dollar or something else. So that's the mechanism of the tariff. So the tariff is it forces a tariff is like, look, if you have to buy oil in dollars, that's a tariff indirectly. You have to own dollars to buy oil, right? So what do we sell that no one else sells? I don't know, but let's pretend it's, macadamia nuts from Hawaii, right? We sell macadamia nuts. We're the only seller of macadamia nuts. Well, if you're buying macadamia nuts, you better have fucking dollars on hand. And by the way, this is the whole milkshake concept. We don't sell anything exclusively except American debt. So people that need dollars are going to have to hoard them to do them. So every time the tariff goes through, that's a strength. So the other mechanism is, to bring it home, the dollar has gotten stronger in anticipation of tariffs. So the dollar is anticipating that. Now, if Powell were to ease rates tomorrow, we're not moving that, but if Powell were to ease rates tomorrow, that should weaken the dollar a little bit. But the fiscal side, the tariff side, is what's strengthening the dollar right now. That's, by the way, whenever someone says to you American exceptionalism, they're saying, no, I mean this not facetiously or sarcastically. American exceptionalism is many things, but what it is stocks going up with a strong dollar. That's it.
Right.
So once stocks continue going up with a weaker dollar, that's no longer American exceptionalism. That's America being competitive with its overseas currencies on a fair market. Mm-hmm. Does that answer the question?
Mm-hmm. So Vince, I want to crystallize this a little bit more about this idea of tariffs and if they end up going through. I saw a tweet this morning about Trump considering ending the federal income tax. So is he trying to, in some ways, make this shift from funding the government by income tax versus through tariffs? Is that a reasonable way to think about it?
No, he is. That is the right way to think about it. In fact, John Paulson did a couple of interviews on this topic explaining their position, and I thought he explained it quite well. I mean, I don't agree with it, but he's John Paulson, and I'm just me. But the case was made and you could search this and you'll see Trump saying this as well. The case is very simple, using precedent of other presidents, using American Revolution times, that we're not going to tax the American citizen. We're not going to tax productivity. We're going to allow them to participate in the economic revival. We're going to tax other people. So tariffs are exported taxes, right? So for using Trump's words, there's an internal revenue service, and he wants to create an external revenue service, which is, funny, and I guess it's possible, but how are you going to collect unless you're using the Navy pointing guns at them? But I guess the point is that he believes mathematically, this is Paulson's take, that the revenue we create from tariffs directly will offset the money that we lose in income tax. So let's assume that it's a wash, but now it's not going to be a wash. Let's assume that it is a wash, but it won't be a wash overnight. Mm-hmm. There's no magic switch. It takes time to do these things. Now the bonus, this is the Trump brand bonus, is he's going to say to a country, let's say he does it to Germany, right? He's going to say to Germany, we're tariffing your goods, 100% tariff on anything that Germany wants to sell to us. Now, we're not going to do that, but let's say he did. This is how you negotiate with a country. It's a very real estate sort of thing. 100% tariff, no more BMWs, no more Mercedes-Benz. Yeah. Screw you, we're buying American, which, by the way, is what we did in the 70s. And it didn't work, but this is what Trump's saying. He's saying, betting on himself, he's saying that companies in those countries will say, dude, I make BMWs. Can you give me an exception? And he's like, well, what are you going to give me back? I'll build a factory in the US. Great. So what's he do? He converts the threat of a tariff, to his credit, to building in the US, to creating domestic jobs. He's encouraging foreign companies to come here, which, by the way, is what China has been doing for the last 15 fucking years. And although they're having a hard time doing it, they are definitely colonizing the Asian ring to that effect. So Trump's saying to everyone, don't sweat it. I'm going to bring the companies back that we need so the tariff doesn't affect us. So in American Revolution times, we're like, you know what? All we're doing is chopping down trees and giving it to England, selling it to England at a reduced price, and then we're buying finished tables from them. Well, the U.S. is like, and when we said back then, it's like, you know what? You can't buy foreign tables. You got to make your own. And so that was the tariff back then that made us self-sufficient. The other term is autarky, right? So now he's basically saying, we're not going to buy BMW. Screw you. And to the extent that he's successful with it, companies will say, psst, dude, I'm German, but, can I open a factory here? What do I need? And that's all part of it. If you invest $100 billion in the U.S., you get citizenship. Look, that's economic citizenship.
That's another form of American exceptionalism.
Exactly. We're attracting entrepreneurs here. And you know what? Even if it's like a drop in the bucket, he's going to broadcast that shit. Mm-hmm. And it's going to attract other people, and it's going to make, and I say this genuinely, it's going to make Americans feel comfortable with the path we're on. It'll make Americans feel more comfortable taking some of the hardship that will come along with it. Mm-hmm. If he doesn't negotiate well, like a real estate guy who doesn't negotiate, look, I'm opening a mall. I'm building a mall. He's building a mall, right? And he's like, no one could be a part of our mall. And then he goes to Apple or who's a big store like the Gap. He says, hey, how would you like to be an anchor tenant in my new mall? I won't charge you the tariff. I'll just charge everyone else. And that's how you do it. That's a real estate play. He does real estate. Very smart. It's how you get baseball teams to move, which, by the way, his father owned the development that the Brooklyn Dodgers lived on. And when they relocated, he built the real estate on it. So it's all very real estate oriented for this guy. Mm-hmm. And whether you agree with the method or not, it's how he's going to fucking do it. And if he's successful, he's going to do it his way. And I think, at least he's focused on how he does things. So, in the end, tariffs are a means to answer your question directly. Tariffs will cover some of the taxes, right? With the potential kicker of companies building factories here. Mm-hmm. Now, the other aspect of it is it's a three-pronged table. It's a three here. This is, if you want to look at it this way, there's tariffs. I'm going to raise tariffs. I'm going to lower taxes, and I'm going to spend. Mm-hmm. And the top of the table, that three-legged table, is the manufacturing rises, right? So one's got to offset. It's a bad analogy, but the point is, this is where the fucking status quo government comes in. If he can't get the tariffs passed domestically, then he can't lower the taxes.
Right.
To your point, tariffs versus taxes, that's what it is. If he can't do one, he can't do the other. And if he can't do either, this is where the weaker dollar comes in. If he's blocked at every stage, Democrats, no, rhinos, no, unions were going on strike, well, then he can't lower taxes. If he can't lower taxes and he can't raise tariffs, what's he going to do to make America great again? Well, he's going to get the dollar weaker. He's going to ask Powell to lower it. And if Powell says no, which assume he will, the dollar is going to have to be weaker anyway, because everyone's going to say, well, if America can't do that, America's headed towards stagflation. Powell's going to have to ease anyway. So instead of buying dollars, you can't get tariffs, sell dollars. Oh, economy's doing worse, sell dollars because Powell will have to ease. And so in the end, if he can't do one, he can't do the other. And that's it.
So Vince, to kind of wrap all of this together, do you remember another time in history that felt so, I don't want to say chaotic, but that felt like there were so many balls in the air, where there feels like there's a lot of change on the horizon, or so much change on the horizon?
Yeah, that's a hard question to answer because I look for historical analogies. Mm-hmm. So one analogy that I've used is that one analogy that I firmly believe in and is observable empirically is we are undoing the late 70s through 2009. So we're going from a we're going from a manufacturing economy to service and back to manufacturing. But the chaos back then, I want you to assume that between 1971 and 1985, it was as chaotic as now. We just didn't know about it because we were all being force-fed mainstream media. So think about it. 71 off the gold standard. Well, that's not all we did. We went and we created the petrodollar. I mean, that's a big negotiation. We cut a deal with Mao. We're gonna, you do this and we'll do that. Let's stop hating each other. Let's team up against Russia. The world was restructuring then. So in terms of chaos, I think there's a similarity to back then. However, I think there's an awareness now that we never were afforded back then. In terms of other parallels, there are other parallels, but they don't fit as neatly as that. You can go back and look at previous presidents. But I will say this, in terms of chaos, the tariff talk, there's no parallel for me. None. Okay? The potential for America putting tariffs on something, let's assume that Trump can't do it at all. Doesn't matter. It's talked about. You're openly talking about a non-globalized world. You're openly talking about Cold War 2.0. You're openly saying, you don't trust us with treasuries, we don't trust you with our customers. That's never happened that I can understand. Maybe when the Berlin Wall went up, I don't know. But you got a president running around, memeing, selling meme coins, which is ridiculous. But at the same time, he's talking tariffs, which is not ridiculous considering the path we're on. So I don't see a more chaotic time except for a war, which, by the way, I firmly believe that except for the killing, we're in World War III. We're in it right now. Mm-hmm. And we're doing our best in conjunction with the other powers to keep it as cold as possible. Because there's one other analogy.
Sorry to interrupt, Vince. The way sure. I've had some other guests explain it was that we're in an economic World War III at this point.
Yeah, exactly. We're fighting it with economies instead of weapons. And by the way, I think that's it. And I think all these other. I think that's a really good point. I think if you look at the wars that we're having right now, those are hot spots that make this a world war. You got Korean troops fighting in Ukraine, but we're not going to call it that. The press is going to keep it out of the headlines of that. We're not going to encourage nationalism in that respect, and we're going to try and work it out economically. And you have these new DMZs. Ukraine is a dead zone. Gaza is a dead zone. It's like you have these new DMZs. And yeah, if we can work it out economically, we won't have military. And by the way, that's how world wars start. Mm-hmm. Economic negotiations fail. World War I is the other parallel that I want to give you. It definitely applies to exactly what you said about economics versus war. World War I, whatever, a guy assassinating another guy. No, World War I was about deglobalization. Mm-hmm. We were going through our first global era. Steamships, Argentina beef shipped to Europe. It was the first global era. Global technology made us a global world. It was great. That's when Argentina really rose because, anyway, so that era, for one reason or another, started to withdraw. So basically, you had, the history lesson is Rome falls, the Holy Roman Empire falls, and then you have the Austro-Hungarian Empire, and that's your beginning of globalization. before nation states really take over. Now you've got steamships going back and forth in the Atlantic, and you got all this cool stuff going on. And then for one reason or another, and this is the economic part, someone gets left out of the party. And back then it was Serbia. Serbia's landlocked. They didn't have access to anything. They were getting screwed on trade. And so they have like an anarchist movement. I'm getting a lot of this wrong, but that's where your assassin comes from. The Archduke gets killed. And now so I think we're trying to make sure there isn't another assassination. I really do. Mm-hmm. Because right now you're looking around saying the world is deglobalizing, right? How do we avoid World War I? Well, we avoid it by making sure anybody who's got a problem is taken care of. Who's got a problem? Well, let's put a fence around Ukraine. Let's put a fence around Gaza, and let's build a fence around Taiwan, and let's make sure that we take care of any other problems. Because if we can't stop a problem, or at least ring fence it, then it becomes an outright world war. So yeah, it's an economic war.
The analogy that comes to mind as you're explaining this is, there's this smoldering background level of animosity based on this economic tension.
Yeah.
And then if you do have some type of a catalyst, like a breath of oxygen or a wind that comes in, like an assassination, that's what lights that smoldering background animosity.
Right. In fire we call it a backdraft. Yeah. Mm-hmm. A little bit of air, and this whatever's smoldering can just go up quickly. I agree. That's right. I mean, imagine if you're a politician running on nationalism. As nationalistic as Trump is, did he ever say, we're going to bomb North Korea because they're sending troops to Ukraine? Did Europe say it? It's a world war. But we're not going to say it because then it really becomes an open world war. It's kind of like, the emperor is naked. We're just not going to acknowledge it until we fix it.
Just don't look directly at it.
Yeah, exactly. Exactly. I mean, that's right. We are in a, there are some embers of a world war. Mm-hmm. And if the right breeze blows, we're going to have, a full blown out thing. Like, in Asia, World War, the expression is, the Cold War never ended in Asia. World War II never ended in Asia. China, Japan, that shit could flare up. I mean, I don't see it, but that's because we're there. Anyway, yeah, it's I think people are really watching it, though. You think China's not talking to us before they sell treasuries? They want to make sure no country freaks out. Mm-hmm. And, that's it. I agree. That's a good point.
Well, Vince, I really appreciate your time today. You've been extremely generous explaining all this stuff and the chat we had before we hit record here today. Yeah. Is there anything that you'd like to leave our listeners with to think about?
No, I think we want to make gold and make silver great again. Wait, I think I have those hats handy. I'm not selling these yet. But I have them, right? There's the silver one.
Oh, cool.
Right? I'm going to get the AG colored, and I have a gold one around here somewhere. That's actually the gold letters are in there. So yeah, I think root for lower oil prices without affecting gold prices, because I think that'll help us become a manufacturer again. Mm-hmm. That's it. I don't have no words of wisdom today.
Perfect. Of course, Vince runs one of the best gold-focused Substacks that I've had the pleasure of being a subscriber to, all available at VBL Goldfix Substack. Excellent stuff. Tons of material, tons to process and chew on from different points of view. As well, excellent Twitter feed at Soren the K, SORENTHEK. Vince, yes. Always a pleasure, sir. Thank you so much.
Thank you. You too. Great to be here.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.